Sarah Larby from Everyday Investor, guest host and producer. Today we have Kyle Ford from Kyle Ford Mortgages talking to us about what we need to know in today's world about financing, refinancing, rates, and everything in between. And if you are at home looking for something better, a future goals, this is going to be a show for you where we talk about different types of goals and what you can do with equity along the way. Don't go anywhere. We will be right back.
If you're using a re-advanceable mortgage, which means when you make a mortgage payment of, let's say for easy numbers, $2,000, $1,000 of that is going towards principal, which means $1,000 of home equity line of credit opens up every month.
Hey everyone, Lee here at Wise Construction. I got a great tip for everyone this week, and what that is, it's water. Water can penetrate your house from above, below, outside, as well as breaching the drain. So one thing we like to do, and I recommend everyone to do, is when you're going to spend your money on doing underground plumbing, make sure you have your plumber do a camera of your drains. And this is to look to see what is outside the house. You can have tree roots, you can also have a collapsed drain. When you finish your property and your basement, to bring water in after the fact will cost you guys an equal amount to redo your basement. So do it proper the first time and get your drains cameraed.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Thanks, guys. Omar Khan here with Data Trading and the weekly market update. Now, the markets have gotten off to a pretty rough start this year. I'm talking about the NASDAQ and the S&P 500, the largest in the United States. And the reasons are pretty simple. The markets are a forward-looking mechanism. It's looking forward 12 months. And there's a lot of concern right now. The concerns are inflation, the biggest one, interest rates going up as a result of inflation. And of course, this very unfortunate, dreadful war in the Ukraine. This is all leading to uncertainty. The markets don't like uncertainty. As we get more clarity on the amount of money that companies are making with the next bout of earnings reports that's due this week, we'll get a little bit more clarity in terms of what the markets are thinking. But in the meantime, the markets are concerned about inflation being too high. And thus, as you guys can see, the central banks have been forced to raise interest rates. Now, the idea is this will slow the economy down and therefore bring it into a soft landing scenario. So let's see what happens. But the idea at the end of the day is what we will always do is we will look at how profitable the companies we invest in. That's what ultimately matters to us. Back over to you, and we'll see you guys next week.
Kyle Ford, welcome to the show. How are you?
I'm wonderful. Thanks for having me.
I'm excited. We're going to talk about a lot of things that are very pertinent happening in today's world. But first and foremost, I want to say thank you for coming on again. You are always bring a ton of insights, a ton of great information. And today we're going to talk about interest rates and refinances and all of that good stuff. So let's get started.
Yeah, I'm excited to do it and always happy to be here.
Awesome. So let's talk about interest rates. We have an interest hike that just happened recently, and you must be getting a lot of phone calls.
Yeah, I recently had a client call me and ask me about this, and he said, well, I just don't want my payment to go up anymore. Mm-hmm. Maybe I should lock into a fixed rate right now. And I didn't know if there was a bad connection or he just went quiet on the phone, because when I told him the increase in payment going fixed was over $300 right now, he couldn't believe it. Mm-hmm. And I immediately said, well, let's keep riding the variable rate out. So absolutely, if you're going to be up at night in a cold sweat, not able to sleep over this, then maybe you should consider locking into a fixed rate right now, but expect a significant jump. Variable rates and the spread between fixed and variable is substantial right now. It's over a full point is the terminology we use in the space. It's over a full point right now. So on a $500,000 mortgage, you could be expecting an over $300 increase. Mm-hmm. A couple tips or tricks to consider. Yeah. If you're gonna lock in, maybe don't do a 5-year. You might be able to get a reasonable 2 or 3 year fixed rate, or inquire with your broker or bank about a static variable payment. What static variable means is even as Bank of Canada adjusts the rates, your payment won't move. Your balance between interest and payment will adjust. A little more money will go towards interest every month, but your payment won't change. So you don't need to go right to a 5-year fix. Ask about, if you really can't sleep over it, ask about a 2 or 3 year fix, or inquire with your bank or broker about a static variable payment.
Right. So like essentially as you're paying your mortgage, or maybe if you're an investor, your tenants are paying your mortgage, there's a principal portion and there's an interest portion. And so what you're saying with this option, the static payment, is that there might be a little bit less principal, a little bit more interest. So you're paying down the same amount in total per month, but that ratio shifts a little bit.
Exactly. As on our investment properties, a little bit more tax deductibility at the end of the year. And personally, at the end of the day, if the higher payment is a concern for you, the static option is best. In my experience with most of my clients, they've been stress tested so much on the qualification. When they actually hear what a quarter point means to their payment, it's like this instant, oh, no problem.
$28.
$28, no problem. I can do that.
Right.
Now, and for those families who are struggling and are maybe that is a significant increase, absolutely talk with your bank or broker about options. Maybe you could extend out your amortization.
Right.
You can lengthen out the length of your mortgage to make your payment more affordable. Life in general is getting more expensive with gas and groceries right now. So it may be beneficial for you to restructure your mortgage to make sure that maybe it means locking in, maybe it means staying on variable but having a longer amortization on your loan. There's options for if you're maybe doing accelerated weekly, you could slow down that cycle going to monthly. There's lots of things that you can do here before we need to panic about rates going up. You said it great, Sarah. This needed to happen. We needed to see this interest rate hike go up. So we don't need to panic, and make sure you speak with your expert about the right thing for you.
Yeah, and I know they're predicting, more increases along the way as well, which, ultimately if that's another 0.25, 3 months later another 0.25, it's $28, or on $1 million it's going to be double that. In the grand scheme of things, though, you're still better off because you were talking about how there's that point difference between going in fixed and variable, but it really does depend on that person, right? So we're not saying everybody go variable or everybody go be fixed. I think they should reach out to you and say, here, is my scenario, here are my concerns, here's my risk tolerance, and then you can help them put them into, the best option.
Yep, and I'm gonna add to that, the most conservative spouse wins. Even if you're okay with with everything, if your spouse isn't, generally you're going to want to go with whatever the more conservative spouse wants. So
right, and I think there's also something called advanceable mortgages, right? Where like if worse comes to worse, like you could almost you have a HELOC that opens up as you're paying down your principal, or a home equity line of credit, and you can almost use that as part of the payments to offset the difference. Or what are your thoughts on that? Yeah,
you nailed it. That's such a great point. If you're using a readvanceable mortgage, which means when you make a mortgage payment of, let's say, for easy numbers, $2,000, $1,000 of that is going towards principal, which means $1,000 of home equity line of credit opens up every month. If you've been paying that for a number of years, and let's say over the next 2 years we see multiple increases, you have a substantial line of credit built into your mortgage product that can help service those payments for you. The pros and cons, you won't be paying down your mortgage as quickly, but you can maintain a comfortable payment, maintain your lifestyle, and likely if we've seen these increases, you still have substantial equity in your home.
Absolutely. What do you think that could do to the market itself? Like, do you think, I know nobody has a crystal ball, but do you think by having these interest rates, they're going to be able to slow down the rate of the increases that we're seeing these days?
My crystal ball's been in the shop for a while, but I'll do my best. I like to look at other fundamentals in the market, like the supply issue that we're having, the very low vacancy rates,
the immigration
that we need for our labor market right now. We need the immigration here, but we don't have the housing. So that to me is what's driving the market. Now, I hope that some of these interest rates can get a hold of this market. I am a real estate investor. I have benefited off the growth, but I'm not naive. I don't, 20, 30% is not sustainable. I'm quite happy in a 3, 5, 7% market.
Right.
I'm not greedy. That's great for me. So I do hope that some of these interest rate increases help wrangle in the runaway increases that we've seen, because it's not sustainable.
No, it's not. So somebody that's had, you know, a property for 3, 4, 5 years, they've probably built in a lot of equity since then as well. And with the rates increasing and that kind of stuff, I mean, and again, we don't have a crystal ball. Maybe it'll go up 3, 5%, maybe it'll go down 3, 5%, or something, you know, more or less of that. What are some of the things that they could be doing today to potentially unlock some of that equity and redeploy it and use it to make a better return potentially? Just because we've seen these 30 and 40 and 50% in these markets. Thoughts on or insights on that?
Yeah, absolutely. Reach out to a trusted investor-focused mortgage broker team or your trusted banker. That you absolutely want to be reviewing your current debt structure on your home. Many Canadians have a retirement plan that includes tapping into the equity of their home when they retire, which I think is a great strategy. My advice is don't wait till you retire. Start now reviewing the debt structure of your home and look into tapping into that equity now so you can take advantage of the time between now and your retirement date. There's products like a home equity line of credit. You can simply do a cash out refi to pull the equity out. The main concern I hear is around penalties. And I'd like to debunk a little bit of that. All a penalty represents to me is how much in interest you are going to overpay in the remainder of your term based on today's rates. So when I hear a large penalty, to me, that just means my rate was way too high. Now, we got to do some math here to make sure it makes sense, because it doesn't always. But on a daily, weekly, and certainly monthly basis, we are breaking mortgages with a significant penalty because it allows the client to lower their monthly payment, it pay more principal on a monthly payment, on a monthly basis, pardon me, and most importantly, tapping into their home equity, which allows them to invest for their retirement and future.
Yeah. I mean, this show is about everyday investors, and so unlocking some of that. If you don't have cash sitting around, or you know you're not too sure what to do, at least having the ability to have the home equity line of credit or the cash available so that you can figure out what your next investment move is. And I think just keeping a pulse on the market is really important. Like even as an investor, right? So like obviously if you're a homeowner and you've got the equity, you have that option. But if you're an investor, there's definitely a good opportunity for you to revisit, potentially do another refinance, unlock some of that capital, because it's easier, from my understanding, to do this while you don't need it. You don't need it right away.
Yeah.
And getting access to money before you actually need it is probably a lot less stressful.
That's right. We've all been to the bank. When we need the money, they don't want to give it to us. When we don't, all of our line of credits are being increased, credit cards, everything's in the mail. So absolutely, being proactive in your plan, creating access to home equity, and you said it perfectly. Even when you don't need it, just create the access to it so it's available. Not only is that strategic from a financing perspective, it also puts you in a position to act quickly. So when that great deal that you've been waiting for, or private lending opportunity, or property, or land development deal, whatever that may be, when it becomes available, you're in a position that you can take action. So.
And sometimes the other thing too is that this is like one of the benefits, because I like variable personally. Again, it's not everybody's cup of tea, but the fees are a lot less expensive, right? So when you take a pulse on the market and you're like, I have X amount of equity in there, I'm able to then without as much penalty do that refi.
That's one. So I'll give you. There's two slogans, and I'm full of this stuff. Life is variable. Your mortgage should be too.
Yes.
That's my humble opinion on that. And the second one is mortgage liquidity versus payment stability. In our stress test environment, we are qualified so much higher than we actually pay. You can afford your payment. Unless there's been a major change in your health, job, life, so if you can afford your payment. The mortgage liquidity on a variable means that you can leave that mortgage, sell or refinance the property with a 3-month interest penalty. We're generally talking between $1,000 and $3,000.
Amazing.
On a fixed rate, we've seen penalties as high as $40,000, $50,000, $60,000. And that's the mortgage stability, mortgage liquidity versus payment stability that a variable rate gives you versus a fixed.
Amazing. Such wonderful insights. You at home, don't go anywhere. We're going to be right back.
Blackjack Contracting Inc. is a premier contractor for real estate investors, having transformed over 250 single-family homes into multiple legal suites. Blackjack is proud to introduce their newest venture, reicontractor.ca. Check out reicontractor.ca to get support with planning, design, renovation services from the most experienced real estate investor contractors. reicontractor.ca. Powered by Blackjack Contracting.
If you're looking to raise more capital, do bigger deals, and scale your portfolio, the Multifamily Conference is for you. The Multifamily Conference is live and in person May 14th and 15th in Toronto. Put yourself in the room with multifamily investors from across North America to network, learn, and have fun. Tickets are on sale now at multifamilyconference.ca. Shark Tank's Kevin O'Leary will be sharing his capital raising secrets. Joe Fairless, who controls almost $2 billion of multifamily assets, will be breaking down his scaling framework. And our other top speakers cover every single aspect of the multifamily business, including underwriting, financing, management, deal flow, structuring, and much, much more. Get back out there. Face-to-face networking is back. Reserve your seat now at multifamilyconference.ca.
Welcome back. So, Kyle, I'm going to put myself in a newer investor's shoes, or it could be a homeowner, and you can kind of walk us through what you would do to be able to help us out. So let's just say, for example, I bought a house back in 2015, and it's worth a lot more today. Maybe I bought it for $500. It's worth $1 million, $1.1 million. But I, have let's just say a mortgage with one of the big banks, and I want to get into investing. Like, what are some of the steps that you would go through with a newer investor or somebody like me, for example?
Right. Okay. So we always like to start with both short and long-term goals. A great saying is begin with the end in mind. Where do you want to be in 5 years from now? If your goal is to buy a lot of properties, my advice may be different than if your goal is to maybe just lend your money. There's some conversations we need to have around debt. Are you comfortable with that? Because the structure that we put on that mortgage is going to dictate how much debt you're going to have throughout your life. And if you want less debt, you probably can buy less properties. If you're comfortable with that, I can structure you to buy a lot more properties. I'm not going to tell you one way or the other what you should do, but I can structure you either way. So if you've owned this property for 5 or 7 years, where does the time go? And we're talking about $500,000, $600,000, $700,000 of equity. The first thing we do before we talk about buying any other properties is doing a review on that debt structure. If your mortgage is up for renewal, that's great. There's no penalties or fees associated with it. But if it's not, we may need to break that mortgage to change the debt structure. If your goal is to buy properties, low and slow. What that means is we need long and slow. We need the longest amortization, the slowest monthly payment. What that does is creates the highest debt coverage ratio. So we've borrowed as much money as possible with the lowest payment. By doing that, that creates the lowest payment for buying the next properties. Some strategies that we can talk about. One of the best things that you can do as a new investor to grow fast is to move. If you move into the next property and rent out your old one, you qualify for more than if you were to live in your current property and rent out the next one.
Interesting.
Most people, a lot of people didn't know that one. I'll give you an example. When I was a young guy from 2015 to 2018, I moved every single year. And it wasn't because of the 5% down. It wasn't because of any of that. I moved in my property, renovated it, fixed it up, rented it out. Now it was paid for, and I went and moved into the next one. So it allowed me to move faster. So the next thing we should talk about, if in that scenario, is can you qualify on A rates to pull all this money out of your house.
Right.
If you can, great, it's going to cost you the lowest amount. Maybe you can't. Are you willing to take a higher interest lender to get access to that equity to invest in the next deal? There's no right or wrong answer, but this is going to be a comfort level thing for a newer investor.
Yeah.
What I like to do is break it down a little bit. If you ask me between mortgaging the money and HELOCing the money, I would say mortgage the money. Pull it out in cash, most flexibility. As a new investor, maybe you want to do that a little bit slower. If we were to pull out, let's say, a $200,000 down payment in cash, now you have some money to buy a property, maybe we could set up the difference as a HELOC. You could do a little bit of private lending with that money to bring in some interest income that helps pay the higher mortgage, and now you have a down payment to buy the next property.
I guess because the other thing to keep in mind as you're saying this and what I'm thinking about is the inflation, right? So sometimes, again, there's pros and cons depending on what you think is going to happen with the inflation of having the cash sitting in the bank if you don't have a property or an investment to go to. But I do like your idea about, potentially if the risk tolerance is there and that kind of stuff to take some of the HELOC and loan that out.
It's one challenge that I've seen with many new investors who are in this great position that you talk about, $600,000, $700,000, $800,000 in equity. It can be hard to invest it quickly in good property deals. And not that you can't get it done, but maybe you want to just separate it a little bit, where I'm going to start with a little bit of lending just to get some consistent revenue coming in. The private lending income is the purest form of cash flow. There's no tenants, there's no toilets, there's no furnace or roof that's going to go. If you have a 10% rate, you're getting 10%. So if you start with a little bit of private lending to get that money to work short term so you can get it back in a time period, buy one or two good quality properties, get used to becoming a landlord. You and I have experience in this space, and buying one or two more properties isn't a big change to our life.
Right.
But a first timer, it is. And it's a good scary, it's a good new feeling. So buying those first one or two properties is a great step. And then doing some private lending to get your money to work for you. The great thing about the type of lending that my team offers is it's short term, 6 to 18 months. The reason why we preach that term length so much is it gives our investors liquidity, so they get their money principal back and they can make a different decision. I have some lenders that lend it back. I want that interest income. I have others that say, that was great, but I'm going to buy another property. I want to buy a cottage rental. I want to buy a duplex.
Right.
I want to invest in land development now. So the short-term liquidity of private lending, short-term lending gives you liquidity, which allows you to change your strategy. And for somebody, this hypothetical example, the great thing is this person has the ability to do a couple different things. Spread it out, get your bearings, get used to this new investment space, and figure out what strategies work best for you.
But I think that is just super important to understand, because that is the difference why, for me, one of many differences, I would work with a mortgage broker like you versus just going to the regular bank. Because the regular bank is not going to say, hey, let's take your money and we can invest it privately for a good return. They're probably going to say put in the mutual funds and stuff like that. And again, different returns, different things for different people. But you can do both. So it sounds like you could do the mortgages, the investments, the opportunities, refinancing so that they have an equity to start, at the same time provide an option for them to be able to lend their money to make a return.
Yeah, and not all brokers are cut from the same cloth.
Right.
There's many incredible brokers out there that are great at helping you pay off your mortgage and getting a really low interest rate. And there's brokers like myself that we specialize in different things. I'm less concerned about saving you 0.1 on your interest rate and more concerned about helping you get 2 or 3 more properties. And I promise you, if you get 2 or 3 more properties, you're not concerned about 0.1. You're also probably not concerned about the 0.25% increase that just happened, because you're building your wealth. You're focusing on the top end, and we're going to be responsible about our bottom line, but we're focusing on our growth of our business and our properties and our wealth. So these small changes aren't affecting us the same way.
No, and I do want to go back to that, because I think a lot of people that are new and just recently getting started, they care more about the rate. Hey, what's your rate? And they're going to go somewhere else. Hey, what's your rate? That, to me, and I have experience in this, and I've been investing since 2013, I don't care about the rate. I mean, if it's like within a point and a half, like ultimately, I care more about the terms. I care more about the flexibility. I care more about, being able to acquire more after this one. So whether it's 2%, 3%, if the deal doesn't work at that amount of increment, it's probably not the right deal for me regardless. But to me, the terms are so much more important. So other than rates, what are some things that people should be asking you about, like term-wise?
So amortization.
Yeah.
Our standard out-of-the-box mortgage that most people get to buy their first house is a 25-year amortization. As an investor, we want 30 every day of the week.
Exactly.
We've been told so often you want to accelerate bi-weekly payments. As an investor, you don't. You want a monthly payment. Just to conceptualize that a little bit, an accelerated bi-weekly payment means you make 2 extra payments a year.
Yeah, so 26 payments.
26 payments. Those 2 extra payments a year increase your overall payments, which lowers your debt coverage ratio, which means you qualify for less financing. So the other argument I'm going to make on that is if you were to take and just do an accelerated, a regular monthly mortgage payment and contribute equally what those 2 payments were as a lump sum principal every year, you would actually pay off your mortgage faster than doing accelerated biweekly. So I digress with that. Monthly payments is another term that absolutely you want to do. The next couple things are when possible, you want to get them. A readvanceable mortgage.
Yes.
That means when you're paying down your principal, it's opening up in a home equity line of credit. Not only could this be a great emergency fund built into your property, cover the furnace, the roof, the windows, the doors, built right into the property. As that grows, it can be a great investment vehicle. You can lend off it. You can use it as a down payment. It can cover additional costs if your variable rate goes up. From there, number of doors and number of properties. When I started in the mortgage, when I started in financial services, it was almost a decade ago. And when I started real estate investing, it was in 2015. And in 2015, the advice was, go to all the different banks. Don't tell one bank about the other. Don't go to all these different places. It's kind of changed. You really want to align yourself with a bank that's comfortable with a bank and broker team that are going to set you up to scale and are okay with you having 5 properties, 10 properties. Have a commercial division lined up for you once you max out of the residential. You don't want, if your broker is saying you're done, sorry, I'm not done. I may be done with you respectfully, but I'm not done.
Right.
So.
And I think that's the important thing, right? Is like going back to that person's goal. If they want 1 or 2, probably any mortgage broker will be able to get them 1 or 2, or most likely a bank will get them 1 or 2. But it's really, if you're looking to create a business from this and scale at a level where you could actually leave your full-time job, 5, 6, 7 plus properties, there's such a strategy to it. And this is where some mortgage brokers won't be able to grow with that person. And at some point, they're going to have to replace their team. So I'll tell you, work with a mortgage broker that you can work with along the way that knows how to help achieve their goals, right? To be able to say, if you want 20 properties, no, sorry, I can only help you after 5. You don't want that kind of answer. You want people to be able to say, or your team to be able to say, okay, no problem, I've done it. I have it myself. I've done it for myself. I've done it for many clients. Here is how we're going to do it, and I can help you along the way. That is really, truly the difference, I think, between you and another mortgage broker that might work more with homeowners, but you really specialize in the investment world.
That's right. Ask your broker, how many properties do you own?
Right.
Maybe they don't, maybe they don't own properties for their own personal reason. Ask them, how many clients do you have who own this many properties?
Exactly.
Many brokers, they're just not in that space, and that's okay.
Yeah.
That doesn't mean they're not a great broker. They just might not be the great broker for you and your goal.
Absolutely.
And if your goal is buying properties, happy to help. Myself and the team, we're here to help and work with those people. So
amazing. So if you're at home thinking, I want to scale, reach out to Kyle Ford Mortgages, and start that conversation and see where you can go and how Kyle Ford can help you reach your goals. Thank you so much for tuning in, and we will see you next week.